Hello friends, last week in my video I shared my thoughts on what is keeping the bulls awake at night, and of course we saw those worries remain present in the market, and that's what kept the upsides. Now in this week's video I want to discuss what's likely to happen in the run up to the budget, which is so anticipated by the markets that there's been a huge amount of change in statistics that I'll share with you in this video. Is this week ahead likely to be a bullish one or is it a bearish one? So, a bullish one is normally associated with a feast and a bearish one associated with a funeral. So, which is why the thumbnail says, is this a feast or funeral in the coming week? As usual, as is my forte, I will base my judgment on pure statistical data, which will keep emotions out. So let's dive right in and begin the journey ahead. On your screen right now is the weekly market outlook window, and that basically tells us that it was the broader based Nifty 50 which led the decline, and the banking sector brought up the rear. The US dollar index plunged sharply. There was profit taking after a spectacular run, and of course there had been announcements in the US politics that also led to this move. Now a fall in the US dollar index did not manage to buoy up silver prices, though gold went up a tad. Crude and natural gas fell. I've been telling you that this is a seasonal cyclical rally based in the winter rather than the markets being under any kind of a supply constraint whatsoever. Now, the US dollar versus the Indian rupee fell, which means the rupee strengthened against the dollar, and that kind of cushioned the decline in our market. The Indian 10-year benchmark bond yield fell, which means bond prices rose, and that also cushioned the bank nifty somewhat. NSE market capitalization fell over 2%. That tells you that the decline was fairly broad-based. Market-wide position limits, more on this in the in-house studies, went up routinely at by 2.7%, and the US headline indices gained across the board, and thereby adding tailwinds to our markets and cushioned the declines. Friends, I now come to the ratio chart. It is the bank nifty divided by the Nifty 50. And why do we do that? It's because of the sheer weightage of the banking and financial sector stocks in the broader markets, especially the Nifty 50. Now, being the heaviest weighted being the heaviest weighted sector, you can see that this sector has the capability to pull or push the broader markets with itself. So, constituting more than 1/3 of the entire market, whichever way this sector goes, that way the Nifty tends to go. Now, take a look at the ratio chart on your screen. What do you see? That there was an attempted rally by this ratio to move up, but at higher levels, which coincides with the 25-week moving average, which is a 6-month span as per the calendar. The ratio could not sustain the upthrust, and therefore what you are seeing is an inverted hammer. Second week in a row, very close to the downward sloping trend line. Now, I have told you that since this bank nifty, banking and financial sector stocks rather, have a weightage of 34.6%, banking stocks must rise substantially for the Nifty to rise as well, which means this ratio must go above 2.35, if not 2.45, for a sustainable rally. Unless that happens, a sustainable rally is not happening. At this point in time, if at all I was to make a call as to where the markets are headed, I would say this is a small red flag. Now, friends, I come to our in-house indicator, and I start with the most telling indicator of all, especially ahead of any major news-driven period. Remember, this budget is a news-driven period, and that is the MWPL. In this video, you will learn all about the ramification of the MWPL as a standalone indicator, as also the ticket size per trade and the churn ratio. Now friends, take a look at the MWPL weekly chart. What do you see? The one thing that's come very upfront and in my face is the way the MWPL has shot up. At 38.98, it is far higher than the previous month and the month prior to that. So MWPL is back to 3-month highs. It is way below the prior expiry, of course, but the fact remains that there's been a huge build-up. Is this worrying? Yes, it's worrying, and it is a positive indicator both at one go. There has been a huge amount of anticipatory buying ahead of the budget. Now that leaves the door open for two things. Number one, the budget is a good one and the market shoots up, which means the MWPL, which has been added on the long side, will start accruing profits. Scenario number two, the budget does not live up to expectations and market falls. This will lead to a crowded exit because all the positions that have been added in the recent week or 10 days or maybe a fortnight will suddenly start to bleed. Now, more about this MWPL ramification in the last segment of this video, wherein I share my trading strategy for the week. So, high MWPL is actually a double-edged sword, and what I am seeing is that there is an overhang of overhead supply coming in potentially in the week ahead. Now, I come to the stock and futures turnover, and what we are seeing on this weekly chart is that turnover across the board has gone up. Part of this reason is, of course, the expiry, because traders tend to square up their positions in the expiring month and roll them over to the next month, resulting in double turnover. And part of it is also because of increased participation. Nevertheless, higher turnover always welcome. Now, friends, I come to the advanced decline ratio, which after the price is the most leading and advanced indicator. And what we are seeing this weekly chart, which is actually the average of all 5 days of advanced declines, tells you that the advanced decline ratio has come down very sharply. At 0.76 compared to the prior week's 1.60, it tells me that for every 100 losing stocks, there were only 76 gaining stocks. Another red flag. Traders, especially the intraday one marshmallow ones, the marshmallow theory is covered in a special tutorial video. The list of all the videos that I want you to see is in the description below this video and in the pinned comment below. Do study those videos as well. So, one marshmallow traders were clearly on the back foot. They were not buying. The intraday guys were sitting on the fence, and that is another small but a red flag. Now, friends, I come to the basis. Basis is nothing but the premium or discount enjoyed by futures compared to spot, and as is the case with options premium, futures basis erodes over time as expiry approaches. But as long as the basis is above 0, which is positive, it indicates some amount of optimism. Start worrying only if the basis inverts or the future starts trading below the spot or negative. That implies short selling. Now, what we are seeing is the bank Nifty basis has eroded very, very sharply. Though the Nifty basis has come down to 1/3 of what it was in the last week, but the bank Nifty's basis is close to 0. Should it sink below 0, which means inwards, that's not going to be a good sign. And do remember, the banking space enjoys 34.6% weightage, irrespective of what anyone tells you that this is just one segment of the market which is appearing weak. Do remember, the total constitution in the Nifty 50 is 34.6%. This is not a sector you want to ignore. Now, friends, I come to our in-house indicator, the impetus. You've trusted it for 4 years. It stood the test of time. And what it suggests that in spite of the fact that both indices fell, the impetus also fell sharply. That means there was a lack of momentum. Retail guys are not showing any signs of aggression. Not really surprising. You have expiry, you have the budget. After the budget, you have the RBI Monetary Policy Committee meeting to determine interest rates. I'm not really blaming the retail guy in not being very forceful in their trades. Now, friends, I come to our exclusive in-house indicator, the lift weight thrust drag indicator. This is something that I update on my social media accounts at the end of the day every day. This is of course a weekly chart. The daily is updated on my social media accounts. Please make it a point to connect with me, especially on my Telegram channels, where all of tick by tick data and other data files that I need to share are allowed only on this platform in any file format. And the contact coordinates are at the fag end of this video, in the pinned comment below and the description below this video. So the lift weight thrust drag index, after having gyrated from overbought to oversold levels, has collapsed sharply from overbought to oversold levels last week. That tells you the amount of excess volatility that a retail guy has to be facing since the last few weeks. That's not funny. This is something that only a trader will understand when you have to pay mark to market. Now, sum and substance, now that the LWTD has fallen from extremely bullish to extremely bearish reading, it tells me that fresh buying is likely to be very, very limited. Not surprising, this is an expiry. Ahead of expiry, people don't raise exposure. So expect very limited fresh buying support. Short covering, yes. Fresh buying, limited. Now friends, that our in-house indicators are done, I now come to the bond market. And as I have been telling you, the cost of funds is the single largest determining factor in the market. And unfortunately, the broader market is unaware about it. I have referred to you Dick's Tokens books, and I hope you've mastered these books. I am going to be recommending a lot of more reading material, study material, which will put you ahead of the crowds. Stick with me, be patient, and keep watching these videos. Now, what you are seeing is that the Indian 10-year benchmark bond yield has fallen. Now, it's fallen by 5 basis points, and it's approaching at the bottom of the bearish channel, and it's unable to go past the 25-week average, which is the 6-month long calendar period. What it basically tells me is that the bond markets are in a semi-state of hibernation. They're not expecting too much in terms of activity where the Monetary Policy Committee meeting is concerned, which is happening in the first week of Feb. Do remember my Telegram write-up about the expectation of what follows, especially after the Bank of Japan raised its interest rates to its highest after the 2008 global financial crisis. Friends, the bond market's done. I now come to the Bank Nifty, and this index has lost 0.36% on a week-on-week basis. It rose on only 2 out of 5 trading sessions, and as the daily chart on your screen shows, the price is below the neckline of an unconventional head and shoulder pattern, and the logical target of this head and shoulder pattern, should push comes to shove, can either test or breach the low made on 4th of June 2024 and could go all the way down to 44,500 or maybe 45,000. That in case is if a crowded exit occurs. The price is below its month-long moving average, which itself is pointed lower, so the short-term outlook is negative for now. Let's now go to the weekly chart, which shows an inverted hammer candle, which shows failure at higher levels. Even though the bulls tried to pull this index up, higher levels met selling pressure, which is something I explained to you in the previous videos called overhead supply. The price is below its 25-week exponential moving average, which is equivalent of 6-month long holding on cost of an average bull. So the medium-term outlook is also negative as of now. Do remember, with 34.6% weightage, banking sector is the humongous trend determining factor for the Nifty, and this is appearing bearish, which is a worrisome factor for the markets. Friends, in the week before last, this index was number 8 on the most volatile counters list as per statistical beta rankings I maintain in-house. It rose 1 notch to number 7. Always a worrisome sign when volatility goes up. Last week, I estimated a range between 50,275 on the upside and 46,800 on the downside, which held perfectly well. In the coming week, I estimate a range between 50,025 on the upside and 46,700 on the downside. In addition to this range, Please also refer to the daily, weekly, and monthly pivots that we update on our Telegram channel, and do connect with us there. Also, please refer to this free tutorial video on how you can use our pivot levels to laser precise your entry and exit in your trades and earn higher trading profits. Friends, the Bank Nifty done. I now come to the Nifty 50, which lost 0.48% on a week-on-week basis. And as the daily chart on your screen tells you, it fell on only 2 out of 5 trading sessions. But Tuesday's fall was actually the deciding factor in the week. The Nifty never really recovered from the weakness of Tuesday. The price is below the support trend line of a descending triangle and its monthly moving average, which itself is turning downwards, which means the short-term outlook is negative as of now. Let's go to the weekly chart, which shows the breach of a descending triangle, which needs confirmation by way of continuous trade below the 22,875 level in the spot on a sustained closing basis, which can open the doors to further downsides and basically test the 4th of June 2024 lows as well. The price is below its 25-week exponential moving average, which itself is turning downwards, which itself is a proxy for a 6-month-long holding on cost of an average bull. So the medium-term outlook is negative for now. Can the scenario change for the better? Yes, it can, provided bulls take the Nifty higher and keep it trading above the 24,200 level. Quite a challenge, but that's the condition. Now, friends, in the week before last, this index was number 18 on the volatility rankings that I maintain in-house. It slipped 13 notches to number 31. Wait, do not get out the champagne yet. Don't assume that because volatility rankings have fallen, volatility has fallen. Volatility remains high. It's just that the relative volatility of individual stocks has risen far faster than the Nifty itself. So the challenge still remains. And this extremely high volatility reading in individual stocks which have exceeded the Nifty 50 is actually a sign of a funeral market. This is a big red flag. Volatility in individual stocks is not something that every retail trader is geared up to handle. Don't skip my own weekly trading strategy segment in this video. This video is divided into chapters. Watch the last chapter, please. Now, last week I estimated a range between 23,875 on the upside and 22,525 on the downside, which held perfectly well. In the coming week, I estimate a range between 23,725 on the upside and 22,475 on the downside. Also watch daily, weekly, monthly pivots and the pivot trading tutorial video to keep you ahead of the broader markets. Friends, I now come to the last bit of statistical analysis in this video, wherein I gauge the retail risk appetite by way of their turnover contribution in the 4 segments. The index futures turnover segment showed higher reading by 2 basis points. Stock futures turnover went up by 7 basis points. Index options turnover contribution fell by 85 basis points. And stock options turnover contribution went up by 75 basis points. Net, there seems to be robust participation. Why? Because of expiry. There is squaring up in the January month and initiation in the February month. So the turnover appears higher. But nevertheless, it is a sign of higher risk appetite. Now, friends, I come to my strategy in the week ahead. It's going to be all about this video which I have shared with you. Do you know, in the calendar 2024, I've been surely but slowly pushing you into learning things which you will need to cope up with the procyclicality that we are likely to see in 2025. So the MWPL video assumes a great deal of significance because MWPL tells you the risk appetite ahead of every major news event like election results, budgets, interest rate meetings, etc., etc. What I'm going to do in the weeks ahead is focus on MWPL and see wherever MWPL has risen sharply in the last 6 to 10 trading session. That's where most amounts of hope have been built up. Either these hopes will be fructified, in which case there'll be a big up move, or they will be dashed to the ground, in which case there'll be a crowded exit and a big fall. But to a trader, he should be agnostic and follow whichever way the price tells him to go. So MWPL will be key. Now, I will use certain filters along with MWPL, which I explained to you in the MWPL video itself. Those will be the churn ratio and the ticket sizes per trade. And do remember what I shared with you in this special video about tick by tick trading. Now, I have downloaded tick by tick charts of all these counters where MWPL has been rising. I have marked the points where most amount of traded turnover has taken place, and I have then collaborated it with MWPL, churn ratio and ticket size per trade. Now you know why I have been teaching you stuff that nobody else talks about. These are special skills for real world traders of a real world, by a real world, for a real world trader. Focus on where the money is going and you will always be ahead of the curve. So I'm going to do this in the week ahead, but where sectoral plays are concerned, I will continue to have theta decay as a backbone of my strategy in public sector undertakings, public sector banks, interest rate sensitives, which I have written dozens and dozens of editorials on my free Telegram channel. Please do go and connect with me there. And oil and gas remains a prime pick for me as far as theta decay is concerned. Where bullion is concerned, the long-term bullish story is completely intact in bullion, irrespective of the fact that the silver and gold prices appear to be running into some selling pressure at higher levels. That's completely all right. Now, where base metals are concerned, they may see some routine end of the month short covering, but upsides are likely to be labored and calibrated, which means the trickle-down effect on metal mining company share prices will also not rise too much in the week ahead. Now, if you're a theta decay guy, that suddenly gives you some amount of opportunity. But do remember that in the week ahead, because of extremely high MWPL, either traders will add more to their MWPL or run out and reduce the MWPL, which means volatility will be huge volatility. 2025 will be the year when standard deviation, which is another metric of volatility, is going to be at an all-time high in the history of financial markets. At least that is what I think. And I've been trading these markets since 1986. I've seen enough bull and bear markets to basically draw from my own experience. Now, what do you do in a hugely volatile market like this? Number one, like I've explained to you in this video, trade small, wait for bigger price moves. That way, your take home remains the same, but your footprint, your risk is curtailed. Number two, like I've explained to you in this video, maintain tail risk hedges or Hacienda hedges. Don't keep your flanks exposed. This is not a time when you want to take risk with your capital, because you might just suddenly receive a big haircut on your capital suddenly. This market is extremely nervous. Now, for where I think the market is tilted towards, I could go wrong. Suddenly something could come up and the Nifty could suddenly start trading above 24,200. Trump could announce something. The war in Ukraine could end. Suddenly there could be good news coming in from XYZ sector. But barring all those circumstances, as of Friday night, the data that I have in my statistical and behavioral trading models, I would say that I am biased towards the market tilting towards the downside. So let's be careful out there. But of course, keep your options open. We are traders. We go whichever way the price takes us. Friends, before I sign off from this video, a reminder to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And in the comment segment, do let me know what you think about our work and how it helps you become a better trader and what else can we do to record even more videos for you. Also, a request, please share my videos with all your friends and family. This is a labor of love. My channel is lifetime free. We are never going to charge you money for this, but we would appreciate it if you can help us to reach out to a wider audience. I thank you for your patience in being with me in this video. Till we meet again in my next. This is Vijay Bhambwani signing off for now. Take care. Have a profitable week ahead. Bye-bye.